How's everyone doing today? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So today I have a friend of the channel returning to do another interview with me, Chad Hall from Janney Montgomery Scott, or as most people in the industry just call it, Janney. Chad is an investment banker. He is back to talk with us about what's happening in the overall bank M&A market. So with that being said, I'm going to bring Chad in. So Chad, how are we doing today?
I'm doing great, Dr. Joe. Doing excellent.
Yeah. But yeah, thank you so much for taking a few minutes to hang out with us again here today on the channel. We always appreciate it. And I think today we're going to have a good conversation, just a 30,000 foot view, if you will, of just kind of what's happening in the overall bank M&A market. So for our viewers out there, I would say I did an interview with Chad about a year ago. And, Chad was kind enough to come on. We just talked a little bit about Janney and what Janney does as far as being an investment bank. Chad gave us a little bit about his background, but today we're just going to focus on the M&A market as it were. So if anybody is interested, though, I will have a link at the end of this episode to my first interview with Chad. If anybody wants to go back and watch that, in case anybody's curious and getting just a little bit more information on Janney. But with that being said, Chad, I'd like to kick us off here today just with a couple questions here. So we have seen M&A activity really pick up here, particularly in the third quarter of 2025. And we just saw a couple of big M&A announcements, and I'll bring in a couple articles here real quick, not to go through these in big detail, but just to kind of show people what's going on. So literally just yesterday, we had the big announcement with Huntington Bancshares acquiring Cadence Bank for $7.4 billion. A couple weeks ago, we had Fifth Third Bank Corp to acquire Comerica for $10.9 billion, which was obviously one of the biggest, probably bank M&A deals in the last 5-6 years. And we'll get into this chart here in a minute. But what do you think is driving this pickup in M&A activity since the beginning of the year? And what do you think is really driving behind this right now?
Sure. So there's a lot of forces at play that have accelerated the activity in the bank M&A space. One of the big drivers has been just the improving stock valuations and pricing for the community bank sector. The KRE, should I say the KBW bank index is up about 18% this year. And a lot of these transactions are structured with the majority of the consideration, if not all of it, in the form of stocks. And so we've seen, despite some instances where we had, for instance, the April 2nd Liberation Day, where we had the market, go south for a while, which caused activity, we've seen that bounce back. And so buyers have more to work with from a consideration standpoint. That's been driven by a couple things. Certainly, we're now, after having a 525 basis point hike in rates over a 15-month span, we're starting to see the Fed easing, and short-term rates are starting to, create. It's a case-by-case analysis for banks, but basically helping some of the funding challenges that banks had, but particularly coming out of the 2023 era with some of the notable failures, the liquidity crisis. That lower pressure is expanding margins, so banks are generating better profits. The quarterly results this year have been impressive as a whole. So banks have been posting strong results, providing them confidence to expand. And then the second part of that is that we have an administration now, unlike when I was with you before, that is much more focused on reducing onerous regulation and is greenlighting M&A activity. And so under the prior administration, sometimes deal activity, you had a transaction announced, you had the regulatory approval process that stretched on and on and on. And that created a lack of confidence, a lack of certainty in deals. Now we're seeing that timetable between announcement and closing shrinking meaningfully, something to the tune of about 30%. And so, that as one part of the improved regulation. The other is that the regulators are permitting, or not objecting, should I say, to banks doing larger transactions and more frequently doing transactions. Huntington is you mentioned acquiring Cadence Bank, where they bought a bank down in Texas earlier in the year, and so they did this right on the heels. So, which in prior periods there would have been a longer duration, more digestion, again, a more onerous regulatory review period. So we're seeing a lot of forces at play that are wind in the sails of expansion-minded bank CEOs who are looking at M&A as a tool to grow their business.
Nice. And now, Chad, let me ask you this: would this be a fair statement? In comparing the previous administration to the new one that just came in, I would say that the previous administration was really really kind of mucking up, I'll call it that way, mucking up the M&A process, where they were really dragging out the M&A process to a point where I think in some instances, you were seeing bank M&A deals that were taking 2 years, 2.5 years to close, whereas probably I would call it a regular deal would take probably a year, maybe a year and a half to close. And I just look at it like this, not that this administration is deregulating, they're just allowing things to go back to normal, so to speak. I mean, you think that's a fair take on kind of what's happening there, just in terms of deal length and time from start to finish?
Yeah. So clearly, under the prior administration, you had a position of delay, on a lot of these applications that were going forward. And yes, some of them did stretch onto 2 years, into the 2 year time frame, which is a terrible way to try and orchestrate a transaction. You have people's careers sort of in the unknown. You have, arguably a lot of capital at stake here invested in the success of the transaction. And then you have competitors that can take advantage of that, potentially you standing still as you're waiting to see if the regulators are going to approve or not your transaction. So very challenging environment. The typical time frame is usually, I like to say, like 6 months, like 180 days that you typically would see a transaction, get announced and then close. We're seeing that shrink, so even a bit more. But we're more, again, back maybe a tad under historical norm, but certainly closer to the historical norm, and that's giving boards and management teams confidence that they're going to get their, when they get their deal announced, they're going to get it closed, they're going to get it closed on time, and delivered as advertised.
Nice. Yeah, absolutely. So let me ask you this. Do you see the M&A activity continuing to pick up through the fourth quarter here and possibly into 2026?
Well, yeah, it has, right? So we had in the third quarter, and there's your chart, we had, the highest level of activity in terms of volume and deal value in, like 3 or 4 years. And so as we go here now into the fourth quarter, we've seen a number of transactions. We had $8.5 billion of deal value announced just yesterday. As you mentioned, or as maybe we haven't, but the Fifth Third Comerica was also in the fourth quarter. So you have a increasing amount of activity and overall deal value. Bigger deals are getting done, and I think the volume isn't up tremendously. It is. We'll probably do about 180 transactions. That's up from about a little over 100 and 110 2 years ago, and maybe somewhere around the 130, 140 last year. But the deal values are getting bigger, and I think that's because you're seeing a lot of the regionals believe they have a window here potentially from the regulatory front and with the political climate. And so if as I spoke earlier, that was pretty much the politics of the prior administration pretty much shut that down. Yeah. The window's open. There's good underpinnings of the economy and other factors at play. Valuations are generally improved, and they're looking to take advantage of this window before and if it may close here. We have midterms coming up next year, and so a lot of that's at play, and so I expect, again, I wouldn't call it a wave, but a steady progression of activity.
And and I'll tell you what, that was a perfect segue into the next question there, Chad. So we see some very interesting activity here recently with regional banks. They seem, in certain instances, to want to solidify their market share in very specific markets around the U.S. Do you see more M&A activity around regional banks in terms of that purpose, to maybe try to solidify a certain region or area of the country as they continue to punch with the bigger banks out there?
Yeah, so certainly we do see that. We've seen a few of these transactions of note that demonstrate that. PNC basically bought Denver, right? They went into Colorado, bought a private bank called First Bank for about $4 billion. We saw that with Huntington on two occasions when they went down to Texas on a bit smaller deal, and then again just recently announced a larger transaction in sort of the Gulf Coast, the Gulf states there. So we see that banks are focused on looking at growing or moving into what they perceive to be growing markets where they don't necessarily have coverage. So I do think that's a theme. And also, if you think about what's happened over the last several years, but during the liquidity crisis, the larger banks and the advantages that they had maybe perceived in terms of government guarantees or whatnot, and some of the regional banks maybe didn't have that implicit guarantee, and they're looking to grow their business and increase more size and scale. There's four banks over $1 trillion. All the regionals are way behind, and they're looking to effectively compete and more with some of those larger big four banks.
Yeah, no, I think it's a very interesting time in this business when you look at what some of the big four banks are doing. I mean, Wells Fargo just came out of this asset cap situation. Citibank kind of has their own thing going. Obviously, Citi's always been much more of an international player than a local U.S. player in a certain regards. But JP Morgan running around the country, actually building a lot of branches, going into Philadelphia, going into Boston. Now, Jamie Dimon just did this whole bus tour of the South where he was going through Alabama and some of those southern states, looking at maybe making a play or doing some more growth there. So, yeah, I mean, very, very kind of interesting when you look at the big four and look at what they're doing in certain regards. But then you do have some of these regional banks out there, like you said, like PNC, that are, perhaps trying to grow a little bit faster, trying to get to that $1 trillion mark, trying to, just, give it a little bit, I guess, get a little more weight or heft, however you want to describe that, to their banking franchise, so that they can continue to hopefully, compete more effectively against the big four. So it is very interesting. But let me move on to this for a second. There are some potential reductions on the horizon for like capital ratios, and some regulatory thresholds could get changed for community banks. Do you think those changes could help community banks, or will help community banks going into 26 and 27? And what, if anything, do you think that would do in terms of the M&A market?
Yeah, I do. So at the community bank level, there's talk now of revising potentially the leverage ratio, which is a way of simplifying some of the regulatory requirements. A few years back, you could select to just be tested at the leverage ratio, which is essentially a function of capital to assets. That level was at 9%. There's talk about moving that down to 8%. I think it do a couple of things. It'll encourage banks that are at 8% or generally operate at that to maybe select to be tested just at the leverage ratio, which will free up some regulatory testing and time and energy around those quarterly capital ratios. But also, I think it'll help banks expand and potentially grow and draw investor interest if they're able to potentially leverage their balance sheets a little bit more and generate a little bit higher ROEs to sort of incentivize investors coming into the space to want to participate. It's the banking industry, as we've looked at it. You can see that there are some reasons to be weary of some credit issues coming into the space. So is this the right time to potentially be doing that? There have been some one-off instances with there's been some notable frauds with
Tricolor Holdings and First Brands and
exactly. Yep. And then sort of the lending to the NBFIs and what that all might mean. But if you look and you'll see the headlines, non-performing assets are up, 20%, 30%, but they're really coming from a very, very low base. And so we see this as more of a reversion potential to the mean. We certainly, need to be guarded and that there'll be exceptions to the rule to that. But it seems like the banking space has done a nice job building capital and running their businesses over, what arguably were some of the hardest years that we've encountered with, the pandemic and then the rapid rise in rates. And so it is appropriate to be thinking about, the current capital levels and whether it might be time to, certainly, not talking about doing anything dramatic, but maybe lessen the blow a little bit to the sector.
Yeah, no, like I said, I find it very interesting because one thing I always remind people, Chad, when I get when people, either customers or, I'm out maybe talking at a function or something, people ask me and they say, do you have concerns about like credit quality, like some of the things again, like Tricolor Holdings and First Brands that we've just seen in the news recently. And I say to them, I said, yeah, I do have concerns around the whole kind of private credit market and some of the things that are going on there. You're definitely seeing some issues in particular in the subprime auto sector of the market, of the auto industry. And it looks like maybe there could be some other issues might pop up there over the next few months, but we'll see what happens. But the one thing I always try to remind people though is that banks are so much more well capitalized today than they were when you go back to the 05, 06, 07 time period. Banks back then literally held capital sometimes of 4, 5, 6%. Now, a lot of times you're seeing banks with tier one capital of 10% or greater. And so I think banks are just in a much better situation today in terms of just the capital, liquidity, just all that. So again, I think when issues do come up, I think banks have a little bit better ability to absorb some of these things today. Do you think that's kind of a fair take on the situation?
I do. I do believe, if you look back historically, banks are way much more capitalized. I think I feel like they're more sophisticated these days as well, as we've kind of, we haven't really necessarily grown the talent pool of the industry as the banking industry is consolidated, but I think we've grown the talent pool and overall for banks on average, as musical chairs plays out with senior leadership and the like. And so I feel like there's a better, view around risk. And, the notable events that have occurred over the last 15, 20 years have all played into that. It's not to say there won't be another unforeseen issue, and we'll know it, but in hindsight. But I feel like we're a bit, the sector's better equipped and better managed, and there's better overall guardrails around it than there have been in the past.
Nice. And then finally today, do you have any other thoughts on bank M&A, or do you think there's anything we missed or anything that you'd add to what we already talked about?
Well, I think we talked about a number of the things that are at work here. There's always geopolitical and macroeconomic events that can change things in a hurry. A tweet can change things in a hurry. But really, we probably have one of the better landscapes we've had in some time now, probably the last 6 years or so. And I think there's just a lot of pent-up demand. There's there's succession issues, whether that's in the boardroom, the C-suite, or just the shareholder base, where they're are looking for the opportunity to take care of those issues, and maybe building a bigger and potentially more resourceful institution to serve their client base. So I think there are other threats looming. We haven't touched stablecoin and other things that are going to shape this industry. Technology is such a big part of it, and the need to invest in it is becoming ever more important. It's certainly not going to eliminate the personal contact, but it's a factor out there. And so I think a lot of these forces are at play that will likely drive continued steady activity into next year.
Well, yeah, and I one of the things I think is fascinating, Chad, is like I just did an episode on this brand new de novo startup bank called Erebor, which is I think going to be located. It's going to be located in Ohio. They're saying they're going to have branches in New York, but it's driven by a gentleman named Palmer Luckey, who is the CEO founder of, and if I'm saying this the company right, Anduril. If I'm probably not saying that right, but Luckey his company does a lot of work with the Defense Department. He's very much into AI and robotics and AI weaponry and things of that nature. But they're targeting a lot of the former Silicon Valley Bank clientele. Like that's really basically what the bank is going to go after. They want to have, I would say, a much more tech-focused, digital focus with, again, like what you said around stable coins, cryptocurrency, digital wallets, that kind of thing. So, you look at somebody like that coming into the market, you look at a lot of the other companies that are trying to get some type of bank charter right now. And I think it makes for a very interesting, the next like 5 or 10 years, how all that is going to play out and how that's going to continue to shift the landscaping in the banking business, I think is going to be very interesting. No doubt. Yeah. We don't know about stable coins yet. Like we really don't know what that's ultimately going to look like. We could take a lot of guesses, but we're not sure. No, I don't think anybody's really sure yet what that all looks like.
Agreed. Yeah. So there's been something like 40 de novos that are slated to come online or in the process of it, which is great because the industry really hasn't had any new banks of consequence over the last several years, and so that's part of the administration's push to bring in to open the door for new entrants, and clearly their view on alternative forms of currency with crypto and the Genius Act and and just innovation in general and technology. These aren't the typical de novos of the past, right?
Yep.
Almost all of them have some sort of, fintech or other, sort of new commerce strategy at play here.
Yeah.
And so, it'll be interesting to see how that all plays out here over the next several years.
I love the word that you used a few minutes ago, sophistication. I think that, like, just like you said, these aren't your dad's de novo startups. Like, I think that the sophistication of these new de novos is going to be at a different level. And I agree with your sentiment too. Like, I think a lot of banks in general overall have gotten a lot more sophisticated in the last, 15 years, just as technology has progressed and will continue to progress, so it is very interesting. I mean, I have thought for quite a while now that, a lot of your jobs today are like, again, not like the CFO job is going to go away or anything like that. But I think in 10 years, it probably looks different. Probably some of the things are done differently than they are today, if that makes sense. Like I just see things changing as we go forward. And like you said, that sophistication continues to evolve and just, kind of changes the way that we do things, but not necessarily for the bad, but hopefully for the better in terms of efficiencies and all that kind of stuff, just making things work better.
Yeah, right. I mean, banking, the industry is not immune from the potential effects of AI, right? And that can be a risk, but it also can be a real benefit. Banks are always looking to squeeze out as much as they can with from an efficiency standpoint, and there are a lot of studies out there that believe AI can help them chip away at that pretty meaningfully going forward. So it'll be interesting to see what the future holds here.
Absolutely. So, all right, Chad. Well, I would ask you real quick. If anybody wants to get a hold of you, or if they want to follow you, what's the best way for them to do that?
Sure. Well, you gave my employer out there, Janney Montgomery Scott. You can find me on the webpage there. My email is chull@janney.com, and that'd be a great way to get a hold of me, Joe.
Perfect. No, thank you so much. And hey, look, I can't thank you enough for taking a few minutes to come back on. We love you here at the channel. We hope you can come back anytime.
Thanks, Joe. Love to. Look forward to it.
You got it, my man. Thank you so much, Chad.
Thank you. Have a great day.
All right, everybody, that was Chad Hall from Janney joining us just to talk about what's going on in the bank M&A space, and I hope that was some really good information for everybody out there. And I'll just wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. And as I said earlier, there will be a link at the end of this video to the first interview that I did with Chad, if anybody would like to go back and check that out. With that being said, thank you for watching today. I appreciate it. I hope everyone has a great day out there, and I will see you again real soon. Thanks a lot.